Okay, let's answer some questions from the last market outlook. I haven't had a chance to go through any of these yet. I have workers at the house tearing apart my bathrooms and my kitchen, so my life is living off a kitchen table with everything on it for the next 2 weeks with a cold shower because the one shower that they didn't tear down has no hot water. So I haven't had time to look at any of these. If I don't know the answer to some of these, I'll read them, but then I'll just pass. Let's see. Do you think this is a good time to take some positions in the banking sector? If we think there would be rolling recession scenario, this could potentially be the bottom of the banking sector. Well, if you don't anticipate that there'd be a credit issue, then sure. What you might want to do before you take any position in any bank is look at the concentration of real estate loans on its balance sheet. Real estate loans are different than housing, than like a mortgage. A mortgage is amortizing, so every payment you make has principal and interest. Real estate loans have interest, sometimes a little bit of principal, but typically a big balloon payment, which means that the borrower must roll over the mortgage or sell the property to meet the obligation. And as we've seen in the commercial real estate sector, in the REITs, some companies are just saying, here are the keys. It's not even worth selling the building to pay off the debt. You can just have the building. So check to see what amount of commercial real estate is on the books of those particular banks that you want to buy. And then if you go into the notes of the financial statements, it'll give you some idea of the maturity schedule of those loans. And then you can make your decision from there. But you may want to avoid that. You may also want to avoid banks in countries where mortgages, where there was a high share of mortgages that are rate resets or floating rate, or limited term, like 3-year mortgages or 5-year mortgages, like Canada has. You can take it out a 25-year mortgage in 5-year terms. Every 5 years, you have to go back and renew that mortgage. So those all reset higher. I disagree that no one believes they will lower rates because of inflation comment, because of an extremely high probability in 2 months. Okay, so I can see where this is going. You're laying out the case that inflation is gone. You're saying, look, inflation is gone. It does not matter what you believe. It doesn't matter what you believe. It doesn't matter what case you can make for inflation disappearing and going down to 2% by the end of the year. It does not matter what you think. You're not a voting member on the FOMC. It only matters what they think. So you can disagree with them, but they're the ones who set the rate. So it doesn't matter if you think inflation is going down, and as such, rates don't need to be high. You can't do anything about it. You have to read the people in the room. And the people in that room are all on the same page. Rates are not being cut this year or next year. And if they have their way, it'll be 2025, which means if you do get this scenario where inflation does start coming down slowly and employment stays strong, they're not cutting rates. You can make whatever case you want that they should lower rates, but you're not in that room. You're not a voting member. Your opinion doesn't count as far as monetary policy is concerned and what we all have to pay attention to. You have no influence. So you may have a case. Your argument that you're making may be right. You may look at all this data and say, well, okay, yeah, sure, that looks like it. But they don't see it that way. So think about it. Keynes said it the best when he described the stock market. He said the stock market is a beauty contest where your job is not to pick what you think the best looking girl is. Your job is to pick what you think everyone else thinks the best looking girl is. So when it comes to inflation, your job is not to determine whether or not inflation is coming down. Your job is to determine whether or not the voting members think inflation is coming down, because they're the ones that vote. And if they don't think it's coming down, which which almost to a person, they don't think it's coming down, they're not cutting rates. So the rate cuts that are priced in, being that the Fed funds futures market is more of a sophisticated market, the rate cuts being priced in right now are a weighted average of no rate cuts versus recession, something breaking, and the Fed has to cut. Not that the Fed will, but that they have to. They'll be forced to do it. I didn't even mention the shelter. It looks like it has peaked. Well, tell the CPI report that today because inflation popped up. Tell the Toronto housing market that because the Toronto housing market has gone up for 3 straight months. And the belief is that the housing market and prices have already bottomed in Canada and are now turning upwards. So, I don't know. I remember the inflation target being 2 to 4% when I said CFL level back in 2010. The under 2% target seemed like it was backed into after years of falling off to generate even 2%. Well, 2 to 4, CFA is global, so it probably isn't going to pick on any one country. That among the G7, they probably range from 2 to 4%. For example, Canada doesn't have a target. It has a range, 1 to 3%. That anywhere within the 1 to 3% range, they say, you know what, we're good. It doesn't have to be 2%, but anywhere within that range. So it could be that at the time, it might have been globally among the developed economies, it ranges from 2 to 4. As opposed to specifically saying the Fed has a 2% target. Let's see. If the government does default on its debt come June, what will this mean for risk-free rate models, formulas moving forward? Any theories on how calculations like CAPM will be affected? If we're struggling to find a risk-free rate beyond government yields, we can always use SOFR, which I guess we can't, because that's the secured overnight funding rate being secured by treasuries. So all we're doing is we're just shoving the default over by 1. I think that's an interesting debate question. I don't know if it's that pragmatic. I believe the president still has options that he can issue some amendment in the Constitution that he can use to say, okay, well, to order the Treasury to issue debt. So I don't know if there's going to be a default. It won't be classified. Well, I guess it would be classified as a default. I'd say it's like a technical default, kind of like workers working without a contract. They still continue to get paid under the old contract till they get a new contract, and everything is retroactive. I bought, I think, up $200,000 now of T-bills maturing June 15th. They're with a 5.3% yield. I'll take them. I'm not too concerned because if they don't pay me on that date, the interest will accrue. They won't just. At least I'm hoping the interest accrues. I'm sure it will. It's all going to be fine. If the U.S. does relax regulation on immigration to assist with tight labor market, won't this result in an uptick in inflation? Yeah, pretty much right away, especially housing inflation. And that is the problem that Canada has right now is if given that housing prices are moving back up and that the Liberal government does not see letting up on its very aggressive immigration targets, Canada, I think, should be bracing for another round of shelter inflation. But you are right. While they're here, they create demand for services, for products, for services. It could. Thank you for your commentary on Buffett's Oxy position. Any other key takeaways you had from Berkshire annual meeting on Saturday? I didn't watch the whole thing. I think the biggest takeaway is you have two very old men on the stage. One of them, I think, is late 90s. One is early 90s. Two of them. But they did, I believe at certain times, they did share the stage with some of their other people. So their succession planning seems to be in place. I think that's probably the only takeaway is, when you look at those two on the stage, you start thinking, when you're in your late 90s, a year is a long time away. Like what's the risk factor associated with these two people, right? As far as Oxy goes, disappointing earnings overall. But I still today sold $55 puts for June on Oxy because I don't think Buffett's going to give up. He can go up to 50% ownership. He's at 22 and change. Sure, he said he's not looking at taking it out, but if you were looking at taking it out, would you even admit that you were going to take it out? The price would just pop as soon as he said that. So, is he being honest or is he playing chess, right? Okay. Take some water here. Should we start to build a position to prepare for the default of U.S. debt if the U.S. goes bankrupt? Well, I don't think they'll go bankrupt. I think there's a difference between bankrupt and default. They wouldn't be bankrupt. They just would miss paying on certain things, of which I think the president would step in and use the Constitution and potentially trigger lawsuits and a constitutional crisis if that's all he had left. Is I think that they would do that. And I think the Treasury would probably at least try to do something that if it got to the point where we're going to default in 3 hours and nothing was going to get done, I'm sure all sorts of emergency things would be done to buy 24 hours, 48 hours, 72 hours to buy something. But this is Washington. It is a clown show. The cameras are rolling, and no politician is going to give up a chance to perform some outrage for the cameras. I'm outraged at the level of spending. I'm outraged the Republicans don't want to pay the bills. And both of those sides are lying through their teeth. Anyways, I found some companies trading both Hong Kong Stock Exchange, Chinese Stock Exchange. Same company, the market price implies a 30 to 40% difference in market cap. Why does it happen? You can't trade. I don't think you can trade. I think you mean Shanghai. I don't think you can trade that. I think you can trade on Hong Kong, but not the Chinese market. I don't think foreigners can trade that market. I think that's only for domestic citizens. So, well, I don't know. The most recent information I have is that if you're not in China itself, you can't actually trade that market. How can you have a cooling of the labor market without an increase in unemployment? You're gonna have to ask Powell that. He thinks you can. You're gonna have to ask Powell how that can happen. Either you have a whole bunch of people come off the sidelines, which you might get if you ban TikTok. You might be thinking, what does TikTok have to do with anything? Being an influencer is a career choice. And you are not counted as in the labor force if you are an influencer. You're not looking for a job. You don't have a job. You're not counted as unemployed. I don't know if you'd be counted as self-employed, but if they ban TikTok, all those people making some money on TikTok would then have to get a job. Or immigration needs to increase dramatically. Could you please elaborate? The market is not expecting the Fed to cut rates. Why the curve is implying 65 basis points lower? Well, you have some people who say no cut, which I think is the Fed. All the Fed members are saying no cut, so the market believes them. And then you have something breaking, right? Well, there is some probability of something breaking and a lot of probability of no cut. So with no cut, you should have a Fed funds futures that is flat. With something breaking, somebody somewhere is going to bet that no, you're going to have to cut rates. And the further out you go, the more likely it is that you're going to have to cut rates, which is why you have a curve that looks like this, because there is waiting on the first one plus waiting on the second one. Some people are betting that something somewhere is going to break, and hence you have a curve that looks like that. Whew, look at this. I'm going to get your take on this issue. Seen a couple of charts going around pointing out that the capitalization of the banks that have failed recently is comparable and even higher than the total sum of all those that failed in 2008. Well, that doesn't say much. If you take all the ones that failed in 2008 and look at the total capitalization of those, they were bigger than the last bank failure, and all the capitalization of those were bigger than the last bank failure. It's like saying, I saw a house that was foreclosed, and the market value of the house was greater than 10 years ago when I saw a house being foreclosed, and the market value of that was greater than the house I saw 10 years ago being foreclosed. It seems like there's more and more market value foreclosures today than ever before. Well, that's only because if you look at a price series, prices go up. So yeah, if you look at a price series of bank capitalizations, they go up. So if you have a number of banks fail here versus a number of banks fail here, it doesn't take that many bank failures at higher market capitalizations to equal that many bank failures at lower capitalization, right? And if you take 2008, 2009, and you go back to the S&L crisis of the 80s, well, there you have the same story again. So you have to control for the growth in the market capitalization of banks over that period of time and say, well, as a proportion of all bank capitalization, what was it? I'm not sure if you're looking at that. Just looking at the sum total. Well, I think that would be, this would be my first pushback. If I were reading an academic paper, that would be the first note that I would make. And I would be looking for something in the methodology when they talked about how they measured it. I'd be looking for something in the methodology that controlled for that issue. And if I find nothing in the methodology that controlled for that issue, it's a faulty paper. At that point, you would say, well, you can't say anything about these conclusions. It's a faulty paper. Needs to be, well, not withdrawn, but somebody needs a serious rebuttal on that paper. In relative terms, it looks like the nasty credit event that we've been waiting for is here. We didn't have a credit event, we had a liquidity event. And all we've got is 3 down days in SPX, bringing us down 5%, during which we got an immediate massive repricing of rates lower, falling dollar because of the incredibly tight correlation of rates and rising gold. And all because of the Pavlovian response of the Fed to provide liquidity at first sign of trouble. Pavlovian response to the market, the price and the provision of that liquidity, because we've been doing so since 2008. My contention here is that we might not even see a meaningful drawdown in SPX, other than these periodic non-trending spikes in volatility, because the equity market moves on liquidity unless we get a severe recession. That's basically what is the thought right now, is that a recession is probably in the works. So many economic indicators are pointing at that. If you look at the last Sluice report, and I know that there is some thinking that, well, it doesn't show that there's that much more tightening in bank credit, but have a look at, percentage of those, let's say that's 0, percentage of those tightening credit, does this kind of thing, does that. And the lines that we have right now are looking like this: recession, draw the line. Everyone's pointing out that, hey, it doesn't look that bad. It doesn't look like the liquidity crisis and the bank failures are causing banks. That's not the thing causing banks to tighten. It's still just a basic continuation from Q4. But look at where we are in levels. Just draw lines back. You have when between recessions, I do these little valleys, but it's more like this long extended low point and then that kind of thing. Well, you've got that going on. It wasn't overall, if you look at it on a historical perspective, we're at extreme levels. It's not that good. But yeah, that's probably the most likely outcome, is that rates go higher. And every day that the bell rings at 4 and everything is fine is another day the Fed says, well, the economy's handling things. Not until something breaks. And it is always unexpected, because if it was expected, it would be planned for well before it broke. So there are a whole bunch of problems that happen in the course of a year that you never hear of because they are foreseeable problems. It's going to be something unforeseeable, much like Silicon Valley Bank just showed up overnight and there it was, that liquidity issue. It's going to be something like that starts something else. And For it to be bad, it has to start in credit. It has to be somewhere in credit. Because if you shut off credit, within a couple of days you bring the economy to its knees if you freeze credit. So that's basically where it would have to be. And I think with if we look at where the Fed is paying for reserve deposits, interest on reserves, it is enough at that rate for banks to redirect money away from lending. Why should I lend to anyone when I can get this? Let's see. I think we've answered that, right? There have been some prominent papers suggesting that wage price spirals do not necessarily occur, and under certain conditions can even be unlikely to occur if wage price rise faster than overall inflation. For that to happen, you have to have increases in productivity. But yeah, that you can get massive. You can not, I wouldn't say massive, but you can get sustained wage inflation above. So let's say that this is your employment cost index. It's just actually won't call it the ECI. Let's just call it wage inflation. And you can have CPI or even PCE. Let's call it, which is way below here. If you have massive productivity gains, because you could pay a worker $10 an hour and they could produce 2 items, which means your cost per unit is $5. Then suddenly there's a big pushback in society. You got to double everyone's wages, but they are now able to produce 5, which puts your variable cost, your labor cost, at $4 per unit. That is disinflationary, even though wages were very inflationary. That is the best outcome for the economy, by the way. When you have that going on, what you have here is aggregate demand, right? You now have $10 of spending power going to $20 of spending power. And the unit cost per unit of output went from 5 to 4. So you have national incomes rising while product costs are decreasing, or even service costs are decreasing. And in a competitive market, some companies will pass this on in the form of lower prices. We don't have that right now. You have wage inflation roughly on par with price inflation and negative productivity. So you got to get productivity positive. When focusing on episodes that mimic the recent pattern of falling real wages and tightening labor markets, declining inflation, nominal wage growth increase tended to follow. Yeah, it tended to follow. Well, of course. Whenever I see recessions and contractions, expansions tend to follow. Well, whenever it's really dark out at night, and just as it starts to get darkest, daylight tends to follow. Well, duh. So you're taking something cyclical. I mean, that's an obvious statement. Let's take something cyclical and say, whenever I see things go up, decreases tend to follow. Whenever I see decreases, increases tend to follow. Really? Yeah, you saw that? I mean, I can read that and I go, well, duh. I mean, all you're doing is saying this is cyclical. But what's being left out, what's being buried in that statement, is the mechanism by which that adjusts, right? So usually recessions adjust that. It leaves that out. It's just saying whenever we see this, really good things tend to follow. Yeah, but whenever you see this, you get a recession, and coming out of the recession, really good things tend to follow. So kind of jumping over the adjustment mechanism here, saying, here's the input, this is the output we see. Just ignore the adjustment mechanism for now. How do we know that wages are not simply catching up to the already occurred overall inflation? So, yeah, you could have, and whenever you have supply side inflation, you're going to have demand for higher wages because the cost of living goes up. So sometimes you can have inflation show up first with wages being pulled along. But you see, when we talk about a wage price spiral, that does not mean that wages happen first. It doesn't matter how you get the ball rolling. So you couldn't get inflation showing up, and then workers say, well, we need wages because the cost of living has gone up, which then fuels inflation, which then fuels the demand for higher wages, which then fuels. There's your spiral, right? There's your price. This is price, and this is wages. There's your wage price spiral. It doesn't always follow that will happen. It doesn't always follow that an increase in inflation will lead to an increase in wages, and it doesn't always follow that an increase in wages will lead to an increase in inflation. Much like it doesn't always follow that whenever we see a little sand tornado starting in our backyard, we see these little things swirling around that it'll turn into a big tornado, but usually that's how those things start, and it has the potential to do that kind of thing. So once that sets in, that's very, very difficult to break. Other than wage price spiral idea, can you explain to me why wages going up slightly more than overall inflation is such a bad thing? Wages have been slightly. It's not a bad thing if it's a redistribution of national income from corporate margins to the employee. That's not a bad thing. But if corporations want to preserve their margins, 12% margins, and you have wages going up at the same time, the only thing that gives is price. Price has to go up. So you can have benign inflation of 2%. You can have a repricing of wages in the economy to 5% if corporations are willing to give up their margins. If they're not willing to give up their margins, something has to give, and that would be price. In agency or in any other security where a significant percentage of the gains come from dividends rather than price appreciation, does it make sense to have exposure via long calls, or is it better to own the underlying? I have a synthetic long position. Let's assume that we're not concerned about tax efficiency or withholding, which means you're holding it in some kind of sheltered account if you're not concerned about tax efficiency or withholding. And in Canada, you can hold it in your RRSP. We have a tax treaty with the U.S. if you hold it in your RRSP. But you can't hold derivatives in your RRSP. So if you're not holding it in your RRSP in your taxable account, and you're just saying you're waving your hand at tax efficiency and withholding, going, I don't care about that, I strongly recommend that you care about that. That's very important. For agency in my taxable account, synthetics. You have to use synthetics to get this done, and agency does deliver capital gains. The dividend I have some in my RSP as well, and when they pay dividends, the amount that they pay allows me to buy more shares each and every time, and it's that compounding, that reinvestment of the dividend and the compounding of it that is super powerful over 4, 5, 6 year period, because you end up building, if it bases out here at $9 to $10 for the next year, excellent. Every month that dividend comes in, I get to buy more at these lower prices, all from the same initial investment, right? It's their money I'm using to buy more of their stuff, all from the same initial investment, so that when it does move up, I'm not going up with, X amount of shares, I'm going up with X plus Y amount of shares now. But if you are holding it in your taxable account, I'm going to encourage you to become more tax aware, especially with the withholding, because it's 30%, right? So it pays 12 cents US a month. The US will keep 30%, which is 3.6 cents. You'll get 8.4 cents per month. And then you have some exchange rate that you have to apply to that. Then if you're in my tax bracket, because this is a non-qualifying dividend, the government just takes away 53% of it from you. So, think about what you're left with after, based on 12 cents, and you lose 30% here. Then from that amount, you lose another 53%. It's just not worth it if you're going to pay taxes all along the way. But if I use a synthetic, I avoid this. I also avoid this because it's capital gain. That means it's 1/2 my normal tax rate. I get taxed at 26.5% on the full amount. So I would encourage you to think that way. Reading through John Hall's textbook, trying to understand theta for calls and puts. My question is, why would theta for put exceed the theta for a corresponding call? I don't know that that's true. Yeah, I don't know that that's true. So I'm going to pass on that one. CME Fed Watch pricing in a pause for June, and even has a 30% probability for a rate cut in July. Yeah, that's it's that rate cut. That 30% probability is not really anybody. I don't think anybody sophisticated thinking the Fed is simply just going to pivot in July and say the job's done. We've seen 2 months. We've seen enough. It's heading back to 2%. We can see it. Let's lower rates to encourage more economic activity. That is just not gonna happen. That any probability there is most likely a bet on something breaking before that date. Does the Fed have the ability to give the market what it wants while avoiding stop and go policies? I don't think so. It's not that I don't know that we should talk about the ability of the Fed here. The key word here is willingness. They don't have the willingness to do it. That's it. End of story. Sure, they have the ability. They can just cut rates. They don't have the willingness to do that. In older market updates, you mentioned we begin to see base effects take hold if the inflation rates for housing. Powell also mentioned at press conference they look at models and forecasts. Could this be a factor in inflation forecast? Well, core services ex housing in CPI, which isn't important, by the way. It's the PCE that's important for core services ex housing, not CPI. Everyone's getting excited about the CPI. The weighting of housing in CPI is extremely high. So core services ex housing can be very, very volatile in CPI. It's much, much lower in PCE, so it's much more stable in PCE. But it did come down, if you want to take the CPI version, from 2.9 to 2.7% annualized, on an annualized basis. So it did come down, but again, it's only because in the CPI it has a weighting that is very large, twice the size than it is in the PCE. Payroll report. There were downward revisions to prior months' releases. How much consideration do you give to downward revisions for prior months for this report? I think the market gave it the right weighting. They saw the jobs report come in higher than expectations, which should have been a negative. But with the downward revisions, it made the economy appear, okay, well, you thought it was stronger than what it was, but it really wasn't. That should give the Fed reason to pause. Right now, it's not a matter of the Fed pivot, it's the Fed pause. Anything that supports the Fed in June going, you know what, we're good here, is going to be bullish. Anything that supports a pause is going to be bullish in this case, or at least anti-bearish. In general, it seems most media coverage focuses on the current release data with limited discussion regarding revised data. Yeah, it could be. I think they have to rely more on their guests who are more educated in these fields to bring those points up. Are you concerned about the Fed cutting rates? Nope. N-O. Without inflation being truly beaten, potentially leading to long end of the yield curve spike. No, I can just say this right away. Am I concerned with the Fed cutting rates? Absolutely not. I'm not an armchair quarterback for the Fed. I listen to what they have to say, and I believe them because they're voting. If they say whatever they say, I can say, I don't know how you believe that, but you're the one voting, and that's what you believe, so I pretty much know what you're going to do. You know, if you think the defendant is guilty in the lack of all the evidence and you're on the jury, yeah, guess what's going to come back? A guilty verdict, right? So, this basically being a situation of being right about the cuts, but being wrong about how the yield curve will respond. No, when it comes to Fed cutting, I don't think so. And I think as time goes on and the market sees that, one of two things are going to happen. The curve will become much more inverted because the belief will be, well, if you're going to keep rates here, something will break. And it's true. Something will break. Something always breaks. Something will break. Or if we go long enough with nothing breaking, you're going to get a flattening out of the curve, or what's called a steepening of the curve. If you're inverted, steepening means it'll go from inverted to flat. The long end of the curve will rise. You mentioned the market seems fixated on looking past things at the moment, which definitely seems like this is the case. An honest question I have is, why don't markets always just look past almost everything apart from things that would be longer-term macro trends? Yeah, I mean, why not, if I'm pricing out, if I'm the dean of a business school and I'm pricing tuition, why not just look out 20 years and say, well, tuition's going to be $50,000 a year, not $20,000 a year. Why not just put it at $50,000 now, right? It's a question of, well, are we even going to be around in 50 years or 20 years? Looking past things is dangerous. Because what you're doing is you're saying, we're going to have pretty much the same linear economy. I'm just going to look past this next thing that's going to happen. So by saying that, you're saying, here's where we are. Well, we're going to have some hiccups like this, but then I'm just going to look past it and we'll just pick up basically where we left off and keep going. Without recognizing that it's some of this stuff that may change the trajectory of the economy, such that you may have something like this, but then you come out of it like this. Right? Or maybe it's something that happens here and you come out of it like this. So this looking past, and this kind of thing here may favor some industries and not others. And this over here may favor some industries and not others. So you're looking past something with the industries that you're in, not understanding that the thing you're looking past may change the very nature of the environment, such that the industries that you're in are the industries you don't want to be in anymore. So this looking past things, I don't really like. It's, again, I made this analogy. I'm driving down a highway and I got to go through a heavy gang-infested town with motorbike gangs and all kinds of gangs in here, and I'm going to come out the other end, and I got this nice new shiny sports car, and I got to get through that town. Well, I'm looking past that. Okay, yeah, I got a bad thing coming, but I'm looking past it on my map. Well, yeah, you still got to survive this. So looking past things, I'm not a big fan of, because again, it could change the very nature of the industry, such that what you thought was good over here isn't going to survive in the environment on the other side. When doing an income factory, when a position moves against you, generally better roll the option forward to avoid assignment, or simply accept assignment. Then play the calls. You can do both. You can play calls aggressively. I'm not a big fan of that, really, because it creates a whole bunch of buy and sells and short-term gains in your account, depending on the tax jurisdiction you're in. You could end up with a lot of these short-term gains and losses that are not really capital gains. Again, depending on the jurisdiction you're in. Rolling them always seems to be a better thing to do, because I'm going to take a capital loss when I roll an option that I'm negative on, only to get more carry on the next one that I sell. So I'm not really losing, because let me just give you an example of how it's not really losing. I'm just sort of rolling over and adding, let's say, just as an example, $50. And I sell a $47.50 put, and I get $2, and the stock drops to $45, and I want to roll over to the next month at $47.50, and I'll usually wait very close to expiration for this. So it's $45. So the option is $2.50. It'll be close to $2.50 near expiration. I paid $2, so I'm down 50 cents. I want to roll it over here. Since it's at 45, it's already got $2 of intrinsic value. I'll probably, get maybe another $2 or $3 for it, because if I got 2 when it was, depending on where the intrinsic value is, it's sitting at 45. I'm selling in the money. I'm going to get more than 2. Maybe I'll get 3. Right? Well, I received 2. What's the incremental amount I received here? I received another $1, so now my break even is now down to $44.50. And I'll take a loss on 50 cents. That in Canada is a capital loss. It's not short-term gain or loss. It's capital loss to offset capital gains that I have. So I'll typically roll them, but I'm usually in no rush to roll them. If you wait, it doesn't, if you wait closer to expiration, you can still roll them. So I'm not too much in a rush to roll them. Also on the income factory, it depends if you're combining it with allocation as well. So maybe, for example, Oxy is probably a good one to do this on now. Warren Buffett says it's not looking to buy things. I don't think he's going to turn around next month and suddenly buy Occidental. If he does, it's down the road. So that sort of gives me permission to start selling calls on Oxy as well. So if you start owning some of the underlying, you can sell calls. Selling naked calls, especially on Occidental, selling naked calls could be dangerous, because what if he does buy it for $90 a share, right? So you can now sell puts. If you don't own anything, you sell puts. If you get assigned something, you keep selling your puts, but now you can start selling 30 delta calls. And if you want to be a little bit more aggressive, you can sell 40 delta calls. You do run the risk of them being called away from you, but now you can, work both sides. And if the underlying has a dividend, well, even better, right? Rolling options. What do you do when your bull spread is in danger? Your higher short put. Oh, bull spread using puts. Okay, your higher short put is now in the money, and your lower bought put is at the money. Rolling actually costs money. Yes, it does, because I need to buy at the money put with higher time value and sell higher in the money put with smaller time value. My position lost. I heard we could make PMCC from it to try to recover. PMCC. I'm getting a brain fart right now because I'm not too sure what PMCC is. It's probably a shortcut for something I've used before, but in the moment I'm not getting what PMCC is. I guess it's something covered call, right? I've done this video on rolling options in the applied series. If you're selling options, rolling becomes really easy to do. And if you're selling on a whole bunch of different underlyings, if you've got a good insurance business, because that's what selling options are, you're selling insurance, right? If you have a good diversified insurance business, you can do quite well on it. Once you start buying options, that becomes a tricky part, because every time you roll them, you got to pay more money, which means that you're not adding to your carry, your positive carry, you're adding to your negative carry each and every time. And at some point, you have to make the decision of, well, listen, if I didn't start in this trade, would I start in it now? So I'm not always a big fan of buying. If you feel the need to buy, if you say, well, look, this stock I think is going to go up, why would I sell a put only to get limited income when I think that it's going up? Well, if you think that it's going up, project out. You say, well, I think in 6 months it'll be here. Okay, well, there's 6 months. And where do you think it'll be? You think it'll be there? Sell a put up here for 6 months out. There you go. So as the price rises to that point, you're going to make all of this because you've sold the put. So you can always engineer the position you want with short option positions. The more in the money you sell an option, the further out in time you want to go. The more out of the money you sell the option, the less and less time you want. When I say less and less time, you don't want to sell 6-month options that at 30 delta or 20 delta. You want to sell 30 to 45 day options. But if you're selling heavy in the money options, grab 6 months or grab 9 months. It is, by the time you look at your delta, let's say this put you sold has a delta of 0.8. Since you're selling, you got a positive 0.8 is equivalent to being long 80 shares. And getting paid for it, because you're receiving premium that day. You're not putting money out, and you're effectively long 80 shares, right? Managing a big enough portfolio, close to 7 figures. Good idea to set up a corporate structure. Okay, so this is someone who's not watching the Q&A. I answered this last week. Not really. Not really. Only if you're going to take in outside money, and even then you're not going to be a mutual fund, you're going to be more of a hedge fund. Even then, a limited partnership is where you want to be, with minimum buy-ins, and only take accredited investors, but not really, no. And if you're trying to do it in Canada, absolutely not. You'll end up overall with a 3% higher tax rate if you attempt to do that. You have to have a very special situation to get that done. The Liberal government has decided that owners who have retained earnings in their business and invest those retained earnings, if you make more than a certain amount, you get a punishing tax rate. I mean punishing tax rate, to the point where, well, I better not do it. So our Liberal government is actively encouraging businesses not to keep retained earnings in the business, to take it out so they can get taxed on it, and then you go ahead and invest it. But if you think that your business can keep retained earnings, and you're making money on your retained earnings, you will get punished. Liberals. Companies like AA, Rio, FCX worth adding now, or wait to... I'm adding them now. Rather than asking someone what their opinion is, ask them what they're doing. And I find that that's a big mistake in polling. One egregious mistake I saw was about the Federal Reserve. Gallup released a poll asking people, do you have faith that the Federal Reserve will do the right thing for the economy? And I think it was like a low amount said that they had faith, like a very low amount. Well, it's like your academic senses start tingling right away, and you start saying, whoa. You can't ask that question. When you say do the right thing for the economy, whose version of the right thing? Do you mean do the right thing the way what you think the right thing is? And you have I think the right thing is to cut rates to zero. Do I think the Fed will do it? No. Oh, so you have no faith in the Fed. Well, that's not measuring faith in the Fed. That's just measuring how many people are on the same page as the Fed. It's a terrible, terrible question setup. So whenever you ask a question like this, is it worth doing something? Don't ask me my opinion. Ask me what I'm doing. If you really want to know what somebody thinks in the markets, don't ask them what they think about the markets. Look at their portfolio. Yes, I am adding Alcoa, Rio, FCX. There's another aluminum company I've been looking at out of France. I'm not ready to share any names because I haven't really made a decision on it yet. But when I do, I'll let you know what it is. But right now it looks for good revenues. It looks fairly strong. But I am looking for companies that are in metals and mining. The auto industry, U.S. I think it was, I don't know if it was just the U.S. or if it was producers in the U.S., which also included, Toyota, BMW, all of those, are pushing back on the U.S. government's requirement that by 2030 a certain percentage of the fleet be electric, by 2035 another percentage be electric. And they're saying all this is going to do is create a fight for materials that don't exist, for battery materials that simply don't exist. And they're right, they don't exist. They don't exist. So that means whatever does get mined, the price has to go up. And if you're doing anything electric, copper, that's what you need is copper. The only way to get to get more without massive improvements in battery technology, the only way to get further range is to make that car lighter. There's aluminum. So that's why I like copper and I like aluminum. I don't know when a good time is. And because I see this as a long-term hold, because you can't just come up with copper. You have to mine copper, which means you need a mine somewhere. There's not enough copper mines in the world right now to meet what the world wants to do by 2030. There simply just isn't enough copper. Being that I'm looking past this, I think it's a good time. But you have to make your own decision for yourself. Perhaps I missed something, but it seems like your position somewhat neutral, bullish by selling puts on SPY, housing, mining, energy, GM. Well, selling puts on housing, mining, energy, GM is not neutral. That's bullish because you're adding positive delta, right? A put has negative delta, so when you sell a put, you end up with positive delta, which is a long position in essence. It's a convex position, a convex long position, but it's still a position. Convex means that as the market goes up, my positive position becomes less and less and less positive, because as the market goes up, remember I sold a put, I don't participate in the upside. So the further and further away the market gets, the less and less bullish my position is, but still it adds positive delta right away. How is it that you're comfortable being exposed to such downside risk? I'm not. So you have positions, right? And you can manage all your positions, or you can take a portfolio approach and say, I have these positions, I'm going to overlay it with negative beta and positive delta. And I have these idiosyncratic risk positions that are diversified enough. Well, I shouldn't say diversified, they're concentrated. You got housing, you got mortgage REITs, and you got metals and mining, right? And I do have some industrials in there like GM and Stellantis and Ford. I have those in there. And I have negative beta. If the market goes down, great. If something really breaks, the market's going to go down. I'll get to buy more of this stuff here, which is what I want. My negative beta will pay off well, and my positive D will pay off really well. So you can manage risk at an individual position level, or you can manage risk at a portfolio level. If I want to become more neutral, if I say, maybe I'm not that sold on revisiting the lows. Maybe we don't see 3,500 or even 3,800. Maybe we might see 4,000 again. Maybe, if I start thinking that, I don't think I would change this. That would give me permission to get more bullish on some of these other positions that I have and add more delta that way. So it's the sum total of the portfolio delta, and it's not just delta, right? It's because every stock has a different beta, so you have to multiply all the deltas by beta. And then, of course, it is the dollar value of all those things as well. So that is the one big portfolio statistic that I watch. And, if you're neutral, if you say, well, I don't know, you want to get that as close to zero as possible by holding underlying positions and being short in other positions so that the sum total of what you have is very close to zero. So it's hard to look at any one thing I'm doing and saying, oh, you must be this, you must be that, right? Let's see. ABR has felt like easy money. I like it. Canadian using IBKR. I have a large negative balance in USD against long USD stocks that is costing interest. How do I hedge out USD without buying USD? Well, you got a negative position. Whenever I have that and I got to come up with something, I short something US. If you short something in US dollars, you'll get US dollars in your account. So if you short, you want to short a non-dividend paying stock because you don't want to pay dividends, but you'll get money in your account if you short something. But you don't want to short something that will then cost you money shorting something that you want to short something that doesn't have a large short float, which you're looking for the second leg of something. Looking for a short position can be tough. Usually I try to avoid those negative currency positions because where the US dollar is right now, it is going to cost you money each and every day to keep it. You can use futures, but that's not going to cover your short negative dollar position. You can sell puts on stocks you'd like to own in the US. That'll start giving you US dollars, but you say you have a large negative balance, so you usually just want to avoid those situations to begin with. Yeah. You probably would use the Canadian dollar strength now to convert some of your Canadian to US dollars. That's what I would do, and eliminate the cost of because right now you're paying you're paying more than 4.33. You get 4.33 on a positive balance, but IBKR is not going to just charge you 4.33 on a negative balance. Chances are you're 5.5 probably on your negative balance. Let's see. Contracts, that's not going to close your negative position, but it will at least hedge it, but with a lower interest rate. So I would say that you're better off right now just getting a flat position, closing that US dollar position. Don't close your stock position, just close your US dollar position. Regarding your GM trade, nice to hear your thoughts on Ferrari. If price went tenfold last 6 years, gross margin of 50%. EV plan, hard to imagine electric Ferrari. Yeah, I know. You don't really drive Ferrari for that reason. Like when you have an ultra performance car, it's because of the engine. Really, I mean, it really is. I mean, that's what you're paying for when you buy these cars. The money is in the engine. Talk why they managed to go in EV revolution. Will they challenge Tesla? No, they won't challenge Tesla because they're not going to make a $25,000 Ferrari. And Tesla's not going to make a $300,000 Tesla. So no, they're in a different category altogether. Could you elaborate exactly how you get this 4.3 for IB in your cash? I do nothing. I just put cash in your account. It's just, you have cash sitting there. I don't actually have to buy anything, and I get 4.3. Only because treasuries now are over 5% over the next 30 days, 5.3, 5.4, that I feel like moving some of that cash that's just sitting there into treasuries. But you don't have to do anything. They just give it to you. That's all. Making a bit of income by taking advantage of high IV. Yeah, if you can find it, right? Well, I can, and selling naked strangles on Tesla, Meta, Nvidia. Naked strangles were put delta. Okay, 0.1. Okay. Comfortable with the risk reward here, and it's not a large percent of my portfolio, but as my portfolio grows, I want to take on more risk. Is there any difference between selling 3.1 delta strangles or 1.3 delta? No, they are not equivalent positions. They may be equivalent in terms of your delta exposure, but they are not equivalent positions because one of them is going to require 3 margins. You have 3 positions. So whatever the margin is that you put out on the 0.1, you'd have to multiply that by 3. Whereas with the 0.3, it is a far more efficient use of capital because you'll require less margin requirement, but you're also taking on higher risk at the same time, right? I'm going to begin trading with a $20,000, $30,000 account. Do you think I should start with index level? I do. Could you suggest a strategy you consider most appropriate given current market conditions? Not really. That you're going to have to discover on your own. I don't want to be your advisor. Really, if you have access to the applied series, there's plenty of education in there where you can then make your own decision about what it is that you want to do. But I don't want to start saying do this, do that, do this. I think it's a good idea to start with an index level because right away you have a diversified portfolio, and an index is not going to zero. An index doesn't have accounting scandals. An index doesn't have insider trading. Maybe some of the components in there do, but because you're so diversified, that idiosyncratic risk is diversified away. So the index, I find, is the safest place for beginners to start because you are diversified. And if you're buying, SPY, you're diversified with 500 of the single best companies in America. There you go. It's a nice, safe place to be that even if there's a sell-off, even if you say, well, there's 10% down, it's only 10%. It's going to come back. It always does. So you have that luxury of sleeping at night, right? If you want, you can always, after you get comfortable holding it for a while, you can start selling, 30-day, 20 delta calls on it. and that will generate a monthly stream of income along with the quarterly dividend that it pays as well. In IB, when I look in the performance on the option with the graph, you can see your potential and expiration, and the dotted line is P&L today. But in IB, where you have all your position, the unrealized P&L is not the same as the dotted line, even you multiply by 100. That's because when you look at that chart, when you first place your order, it gives you the projection. That is using the inputs as of that day. All they're changing. They're keeping all the inputs constant, and the same with the price, the implied volatility, everything stays the same, and you could just change the days on that chart to see how the P&L would change given everything held constant. As soon as things change, it's not gonna equal it anymore. Interested in studying about the sensitivity of inflation and consumption to changes in employment. Whenever academics are interested in studying anything, your first stop is the literature, because it might already be done, right? You don't want to spend 6 months writing a paper only to have a journal say, what, this again? Like, we've got 300 papers on this topic. It's a solved issue, thank you for coming out, but it's done. So you always do a literature review first, a survey of the literature to see who has already done the work. You always use secondary sources first before you spend any time doing any primary research. So if you're interested in doing any research on that, I would suggest you hit an academic database and off you go. Google Scholar will help you get that done. Given the persistence of core services ex housing, it seems like inflation will persist at a higher rate than a long-run goal of 2% until more slack is created in the labor market. Somebody above you disagrees with you in the comments here. In the absence of an exogenous event, is it possible that higher unemployment, lower wage growth, and tighter credit conditions decrease demand just enough to bring inflation down but not cause a significant recession? Well, that is what Powell believes can happen. But he did say he does recognize that goes against history, right? If that's your story, would the current market value 17 to 18 times forward earnings be justified? Well, what we're asking is to say, do we think that an above average equilibrium multiple is justified in a market where interest rates are 500 basis points higher than they've been in the last 15 years? Liquidity is being pulled out of the system, not injected into the system. Banks are tightening credit standards, not loosening credit standards. Unemployment is at a 50-year high. There is no slack in the labor market for which you can add more employees and get an instant productivity gain. These are not the conditions of a bullish trend for equities. So I don't know that justifies an above average equilibrium. That's just my thinking, though. Given the shortage of workers in the U.S. and the current immigration laws, how long do you think the Fed will have to keep rates elevated to loosen the labor market and significantly lower wages? Till something breaks. Period. The consumer won't lead us into a recession. It has to be something else, and it must be credit related. Might be pretty obvious, but how long? How is the long end of the curve going to come up when we know monetary policy has little effect on it and the short-term rates are quite high? Yeah, that is a good question. How would they come up? Because you have pension funds, insurance funds, you got a lot of long-term or long investment horizon funds that haven't been getting any yield are more than happy to grab this yield when they can. How would you get it to come up unless you have the front of the curve really come down? Not that it would go up. The long end of the rates would still drop, but you'd get an upward sloping curve. It is difficult to see how it gets resolved, how you get an upward sloping curve with short rates as high as they are. It is difficult to see that. I don't know the answer to that. Why buying back shares at a discount to book value would add value to shareholders? I think that was already answered for you, but imagine book value per share is $10. I mean, you could just do a simple balance sheet T account, right? Assets, liabilities, equity. You could say, okay, well, we got $100 of cash, we got $80 of liabilities and $20 of equity in book value. So what we're going to do is we're going to buy back some shares. And let's say that you have 20 shares, so that each share is worth $1 book value. But you can buy them back at $15. So you say, well, I'm going to take, let's say $10, and I'm going to buy back some share. But you're buying them back at less than $1. Say you're buying them back at 80 cents. So how many shares are you buying back here? 12.5 shares, right? That means you got 7.5 shares outstanding that now have a book value of $7. So 10 divided by 7.5 is now $1.33 per share book value, as opposed to $1 a share per book value. It's tough to declare GM an income factory when you have been trading it from the 60s. Best described as a loss-making factory. Significant losses were made against its counter, so it's important to be transparent. I've been more than clear last year that GM was my biggest loser. Many occasions I said so. I'm not getting your point. Is your point that if I've lost money on a stock at any point, I can never talk about it, I can never use it, I can never trade it, losers are losers? Does that also mean winners are winners? So my past winners will continue to be winners, my past losers will continue to be losers? I guess I don't get your point here. You could have a strategy that is wrong for the underlying. Does that mean that you can never do it again, that you can never trade the underlying? If your strategy for the underlying is wrong, change your strategy. And that's what I've done. I don't have a buy and hold on GM. I have a trading range that I traded in, and I'm doing okay with it now. But I don't know that I guess I don't understand the point. So on this, if let's say that I traded something in 2005 and I lost money on it, and I mention it today, is your point that must I always say, hey, listen, 17 years ago I lost money on this, it's a loser stock? I guess I just don't understand the point of that one. The kink in the front end of the Treasury curve complex likely is related to the media reporting on Monday. Yeah, well, that's what I think. You've got the 1 month rate that's well above where the Fed funds rate is, and that's got to be just aversion to wanting to be in that tenor. Talked about your opinion on being short Apple. Curious what your opinion on Apple is now. I'm long Apple in my externally managed accounts. So I have money with fund managers, and I can log in because through the custodian account, and I can see all the holdings. I am long Apple. At the time when I was saying that I'm short Apple, this was when they released Maverick. I don't know if you remember the operating system Maverick. If anyone has a Mac, I should have had a trigger warning first that I'm going to use the M word. But it was such a crappy operating system, and it was just such garbage. And they had been, the operating system before it wasn't really great either. So they were slowly becoming Microsoft in the crappiness of their operating system. And if you're going to be Microsoft, then I want to pay Microsoft prices for my computer. I don't want to pay Apple prices if you're going to give me Microsoft quality software. But they've since turned that around. So yeah, Interactive Broker shows SPX Delta for portfolio. Have you used it? The SPX Delta just tells you how many the index equivalent of what you're holding. overall for your whole portfolio what the index equivalent is. No, not really. I don't find it that useful. I don't really find it that useful. Does you actively manage some of your portfolio imply you believe markets are inefficient? No, I believe markets are efficient. There's a difference between being efficient and being correct. Okay? So, for example, let's take a house on a street. And let's see if I can draw this out right. We'll put a bit of an eavesdrop on that house. How's that sound? There we go. Coming down here, there's the drain. There's the garage door, and there's the door for you to go in. We'll put a car in the driveway. And let's say that you're looking at a house. And something happens, and that house is sitting in a neighborhood. And something happens in the neighborhood that lowers or that is perceived to be negative to property values in the neighborhood. Perhaps there was perhaps this was on a nice big lot, and this one's on a big lot, and this one's on a big lot, but these are underdeveloped. And then the city says, hang on now, you must put you must get density in there, so you got to put some rows of townhouses in there. Well, that always will lower the value of these houses here once you start adding density in a neighborhood like that. In an efficient market, this price would change very quickly. So the price on the house would change fast. In an inefficient market, it would take time to show up in these houses, so that over a period of 2 years, you might see the property value start to drop like this. Whereas in an efficient market, the adjustment would be much quicker. That's efficient. That does not necessarily mean that it was correct. This may be the correct price, but it may be priced down to here. Efficiency just means the speed at which prices can reflect new information. But new information has interpretation. Whose interpretation is correct, you don't know. But that the price itself allows for the rapid changing or allows for rapid change of price to changes in information depending on whose opinion is the one pushing the price. That opinion can find its way into prices quickly. Yes, markets are, for the most part, efficient. But there's a difference between being efficient and being correct. Markets are not always correct. Going over my level 1 notes on market efficiency. What's the point of active management? Well, now, active management typically implies beating a benchmark. So here is the S&P 500, right? And it's got all these little stocks in there. And I say, you know what, I can beat the SPY. So I'm going to say ASPY. I'm going to have a fund called Active SPY, and I am going to beat the benchmark. To do that, I have to decide to overweight. I'll equal weight these. I'll underweight this. I'll overweight that. And I got to try to beat the benchmark. Difficult to do consistently year after year after year. That when you look at active managers over, let's say, a 4-year horizon, some tend to beat the market, some tend to underperform, some tend to equal perform. But after you look over 4 years, they all tend to basically give you the market return over a multi-year period. That's if you have a benchmark. But if you don't have a benchmark, in other words, you can do whatever you want. You can go long, you can go short, you can use currencies, you can use commodities, you can use futures, options, derivatives. You can be in the US, you can be in Canada, you could be in Mexico, you could be in Europe. In other words, anything you want to do. That's a different type of active management, right? So that is more hedge fund style investing. So when you look at how to win the loser's game is saying, I can take SPY as a passive investment, or I can invest in ASPY as an active investment to outperform SPY, while management fees here are going to be higher. And it usually is the case that over time, the actives underperform the passives. About 80-90% of them will underperform the passives, only because this active manager has got so many restrictions on what they can and cannot do because that's their benchmark. They've got so many restrictions. So you can beat the SPY if you're allowed to do anything you want. The question then becomes, well, hold on a second. If you're allowed to do anything you want, can you really say that you're beating the... I mean, that's easy then. I mean, you're not really beating the SPY because you were never competing against the SPY. You were competing against commodity prices. You were competing against derivative prices. You were competing against different markets. You're not competing against SPY. If you say you beat SPY, it's because you did the same thing it did, you just did it better. So when I get asked sometimes, did you beat the market? It's like, well, what version of the market are we talking about? And for what part of my portfolio are we talking about? Are you just talking about the whole portfolio in general? Did I beat the market? Well, I wasn't even competing against the market, so it's hard to answer if I beat the market or not. Usually, if you have this kind of setup, your benchmark is a cash rate plus a high yield spread. And typically 500 basis points. Cash rate is what, 5.25 right now, so your benchmark would be 10.25%. It's called an absolute benchmark, and that's what it is you're trying to beat, is a cash rate plus a spread. And if you can do that, well, there you go. Would it be possible that cryptos like BTC become faith-based? Well, they are faith-based, especially among the younger generation. If so, then probably lots of people will act as it's kind of an asset. Yeah. FBI is now working with major exchanges to track down criminal activities of using cryptos. It seems they have better tools these days, considering all the transactions are transparent. Somebody's made that point that all the transactions are visible. Yeah, but you don't know who they are, right? Listen, you can walk down Main Street and you can see all the businesses that were broken into last night. They're visible for everyone to see. Yeah, but who did it? Sure, you can see that something was done, but who did it? I mean, it doesn't print the person's name, their age, their address, where they live, where they were. You don't know. It's all anonymous. You don't know who they are. I find that funny about crypto is that, when you say, they say, well, it's total privacy. You can transfer $1 million to Russia in 1 minute, no questions asked, and it's all anonymous. But as soon as you say, well, it's used for criminal activity, it's all public, right? Well, you can't have it both ways. You can't say it's so public there's no criminal activity, but it's so anonymous you can do some criminal things like send money to Russia in 1 minute overnight. Pick one. Yeah, the ledger may be public, but the identities of the people on it are not public. And every time somebody... I got pushback on the comment section. It goes to a holding sense because every time you use certain words, it gets held for review. The people pushing back follow the same. For crypto, they follow the same pattern they always do. They call you names. Not one offered a legitimate counter argument. Not one, because there is no legitimate counter-argument. So all they can do is call you uneducated, you're stupid, you're biased, oh my God, it's painful to listen to. It's like, this is the best this is your intellectual horsepower right now, calling me names. This is all you got to defend what you're investing in, is to just call me names. Where is your list of things that put me in my place to say, well, there's this, and there's this, and there's this, and this company is using it for this purpose, and that company, and this insurance company's now got this on the blockchain, and this, and car sales that happen on the blockchain happen much more efficiently at this kind of pricing, and the adoption rate is 53. Where's all of that? Nowhere. You know why? Because it doesn't exist. It doesn't exist. It's for criminals. It's for criminals. Period. But yeah, it is faith-based. It's like God, Is there any reason for MBS, CDS And if so, I understand that correctly, agency could sell CDS and receive spread, leverage it, and do quite well. That's a good question, because there is no default in MBS. There's default in mortgages, but usually the equity piece absorbs those losses. It is just known that if you're buying the lower tranches, you are in the first loss piece, that you will lose. If there's a default, you will lose. So a mortgage default in the pool does not create a default on the MBS, but it could be that an SPE simply doesn't pay. I mean, there could be. There are synthetic CDOs. There are CDOs that are made up of CDSs. That's a good question. I think for an agency MBS, there would be, well, I was about to say there'd be little need for it, but I didn't think that there was CDSs on U.S. government debt, but there are, which to me seems like a great business to be in, selling insurance on U.S. Treasuries. It must have been a good money-making business for a long period of time. That's a good question. I don't know enough about the CDS market because I can't participate in it. I don't know enough about the CDS market to know if there's CDS and MBS, but I'm going to have to go and say possibly, for reasons that I'm not too certain of right now, but probably not agency, probably the non-agency. When you say synthetic on agency and ABR, if memory serves me right, means you sold puts, bought calls. Correct. Do you aim for a net credit? You do get a net credit, yeah. Even if it's at the money, you get a net credit because they're such big dividend payers. All that, the present value of the continuously compounded dividend is in the put. Or buy more calls than you sell puts and have dollar neutral. Well, you could do that. And that is preemptively reinvesting your dividends. But yeah, you could do that. A while back, I remember you talking about how you were short some banks in 2008, right before the worst part of the crash. I wasn't short the banks. I was short calls on a lot of the banks. Then they banned short selling. They banned it on a Thursday night, the night before the expiration date. They expired on the Friday. They came out and did it on a Thursday. They could have done it on a Friday. They knew exactly. Listen to me. I'm still angry about it. They knew exactly what they were doing. Paulson knew exactly what he was doing when he picked the Thursday night before the options expiration. He wanted to punish people at the same time. And I'm sure his friends at Goldman Sachs knew exactly what he was going to do, and they were probably long the very calls I was short. Sons of bitches. Yeah, that still bothers me to this day because I was right. And they came out on a Thursday night, the day before expiration. I took a bath on that. 15 years later, there's some speculation they'll do it again. It's not surprising the American Bankers Association calls shorting banks an abusive trading practice, but even former FDIC Chair Sheila Bair supports a temporary ban. I understand where the preventing contagion argument is coming from, but I think the costs of shorting ban far outweigh the benefits. Well, it's shorting it on financials, which... because of the way news travels today, because of the speed at which it gets around, because of the hyper-connected world we live in, it's like the world is this giant living organism with a nervous system, and something happens on a pinky finger somewhere, and the whole brain gets it in half a second. That's kind of what we're in right now. I heard that analogy somewhere. I wish I could give credit to where I heard it, but now I can't remember where I heard it. That there could be some reason to say, well, okay, if you're gonna ban short selling on financials at this point in time, maybe that might be a better thing for the economy as a whole and for the banking sector as a whole. Maybe. I don't know. I avoid doing that. So it wouldn't hurt me if they did, but whenever governments step in to do something, typically they end up doing harm, not good. They typically, not always, but typically end up doing harm. Have you taken any positions to hedge against possible shorting ban? Not on financials. No. I don't know. I don't know what kind of effect it would have overall. It's not like 08, where it was, every financial institution was under attack. And it was ugly, because I was there. It was ugly. So I don't know if it would have the same effect. I have an issue using IBKR. I am short Kupang May. I don't know what that is. May 1350, 1850 strangle. The stock is at 1777. For some reason, my P&L is minus 12. The stock was at 1750 when the trade was at, well, come on. 1750, you're short an 1850 call. It goes from 1750 to 1777. You've got negative convexity in here. Your call delta will increase in your short. Your put delta will decrease and your short. That's good, but this is bad. One will overcome the other. You're down $12. That's the game we play. Come on. The price went up. If you're surprised at this, by the way, if you're surprised, you should not be doing this, because it means you do not understand what it is you're doing if you're surprised at this result. Not that you should not do it, but you should learn what it is you're doing first and the risks of what you're doing, and you should learn about the convexity that exists in this trade and how the price would move if the underlying price moves. You should be comfortable with how it moves. And if this is uncomfortable for you, it tells me right now you don't quite understand the trade you're in. So you're not going to recognize risk when it shows up, because you're not going to understand what the risk is. So for your own benefit, you may not want to do this again until you learn the structure of this trade and where the convexity is. Shed some light on stock price effect on banks themselves, and if the volatile stock prices are making them do anything differently. I don't know if the stock price is making the bank do anything differently, or if the stock price is making customers hyper aware that something is going on with the bank, and they're associating the fall in the share price with the viability of the bank. Because, well, look, we're in this game all the time, so we know what's going on. But there are many people who don't even know what the SPX is or what the index is. If you say where are interest rates, they don't know. They don't know anything about this. That's like 95%. 90 to 95% of the world out there hasn't got a clue what's going on in our world. Not that they haven't got a clue. They haven't got a clue what's going on in our world, in this world. So when they see stock prices falling, it doesn't take much for them to say, well, okay, the bank must be on shaky ground, because that would be a natural conclusion, right? And I don't think they're going to take time to seek out financial advice on that. They'll probably just say, I better get my money out of that bank. The price is falling. And they'll make a simple calculation like that. So yeah, I think it has a behavior on the depositor, which then is going to affect the bank. Steve Leisman, CNBC, said stock price moves in the regionals really hurt them due to equity being part of the capital structure. I don't think it's the market value. I was under the assumption that common equity tier 1 was they issued shares for at par. It's book value. I don't think that's market value. Unless they're holding their own stock on the balance sheet. Not really. First of all, I would have to hear how he said this and what context he said this in. Maybe he said it that way. Maybe you think he said it that way. Maybe he was referring to something else when he said this, and he was it's really not these two things that he was talking about in relation. But that the price did something that then affects their, maybe it was something about their capital ratio, because if somebody's coming in and withdrawing money, liabilities are leaving and assets are leaving. And if you have to sell assets at a loss to meet the redemption, then yes, you're going to hit earnings with a negative amount, which, if you have negative earnings, reduces retained earnings, which does reduce your shareholder equity. It could be that he was making that bigger argument. So here I'd have to take your word for it that that's exactly what he said and that's exactly what he meant, and I don't know that would be the case without me hearing it. What do you believe the best option-based income strategy is for an account under 10K? Ooh, that's small, under 10K. Best income based strategy. Something safe, something diversified, something you don't mind holding on to, something that pays a dividend. And listen, if you have an account that's under 10,000, what you really should have is some sort of contribution strategy to continually contribute to that account, along with something that you're holding that for now is safe. What you have too little money to start taking big risks. Right now, especially with small accounts, it should be about very low risk and preservation of that capital, along with a strategy to increase the capital both internally and externally. So you can't just rely on the gains in the portfolio to increase the value of that portfolio. I don't know what the best one is. I don't know that I would say this strategy is better than that strategy, as much as I would say this underlying is better than that underlying for doing certain things on. So you can find good stocks like Lamb Weston is a good example, that if you were selling 10 Delta puts on Lamb Weston for the last 5 years, I don't think you would have lost once. It just keeps going up and up. They had another round of great earnings. Same with the home builders. I think if you looked at something lower price like KB Homes and you were selling 10 or 20 Deltas on it, I think you probably sail through pretty okay. So it's not a matter of which strategy is better, it's which underlyings represent the lower risk for the strategy that you would use. Is there a SLOOS equivalent for euro? I don't know. You talk about month-to-date issuance of corporate bonds. Can you please tell me where I can locate that data? I don't know. I listen to Real Yield, which wraps up the week, and at the end of the Real Yield, this is from Bloomberg, at the end of Real Yield, they tell you what the issuance was for the week in both high yield and investment grade. So that's where I get that data. Boston Consulting Group just launched a very interesting article. With total shareholder returns over the last 25 years, not surprised to see healthcare and tech sectors outperforming global market, as well as fashion and luxury goods. Surprised with mining, oil and gas, and retail outperforming over the period. When you say 14%, 9%, 10%, these are the returns or the weighting? I guess those are the returns. Do you think it makes sense to bet on those sectors ahead, or would this be too backwards looking? Well, healthcare is related to the aging of the population, right? So I think healthcare in the U.S. continues to win. And I've made this case before that healthcare in the U.S., while it's a domestic business, has a lot of I wouldn't call it an export component, but a lot of a foreign purchases component, because a lot of Canadians go to the U.S. For to jump the line, because you can wait here for a certain procedure, you can go to the U.S. and get it next week. So if you have the money, you go to the U.S. Most foreigners, when they need the best healthcare treatment, will go to the U.S. Cleveland Clinic, Mayo Clinic, Johns Hopkins, they'll go to the U.S., period. So a lot of the GDP created in that sector may look domestic, but it's not. A lot of it is foreign based, just you can't export it, so it doesn't show up as an export. Healthcare will continue to outperform. Tech always will outperform, I think, always. Mining, oil and gas, retail. I don't know about retail. I think mining will outperform. I'm not sure about oil and gas. But because that has two sides, right? There's supply and demand, and I think that supply will overwhelm demand going forward all the time, unless supply is very tightly managed with it, which it does seem like it's doing that. Another point that I question myself is how to study the winners within those sectors as the returns range from 17 to 37. Yeah, you got to pick. You got to find a sector. Then within the sector, you have to find those that are positioned to outperform, which means you're going to need forecasts of what the environment looks like and who can succeed in those environments, who's best positioned for that. That's strategic. There is no algorithm I can give you that says here are the 6 steps. It's, if there was, there'd be no need for me even doing this. An algorithm would run everything. Are you studying any Mexican equity stocks? No, I'm not. How much of the continued resiliency in consumer spending might be due to cultural or societal attitude changes such as treat yourself, you deserve it, or YOLO? Especially Gen Z and millennials, was wondering if the psychological shift is why they seem to recognize prices are higher but still buy nonetheless. I've wondered about this. I have a new employee, younger, tends to do everything online, order food, have it delivered. An $11 meal suddenly costs $25. And why do you do that? Like, why are you doing that? Convenience. Well, I get that it's convenient. There's a lot of things that are convenient, but what? Like, it's $25. Why would you do it? You're going from 11 to 25 by the time it shows up at the door. Just not a thought. It's more like looking at me like, okay, Grandpa. It's like, well, no, it's not just that. It's, it just seems to me that it's such a colossal waste of money. But anyways, I think there is something different in that sense. Although, I'm trying to think back when I was a teenager and in my 20s. I didn't have a bank account. You got money, you spent it. Party time. I mean, you just spent it because, you're only young once. At least that was the sort of mantra when I was in my 20s, is you're only young once. There's plenty of time to retire. You're only young once. So I don't know so much that it's new. Maybe the expressions they use are different, but probably it's not new because I did quite well in my 20s. I mean, I had a job. When I was a student, I was a waiter, and in fine dining as well. You make a lot of money in fine dining, but I could never hang on to it. In one hand, out the other hand, and yeah, it never occurred to me that I should be saving for the future, because when I was young, my future was a career. This wasn't the time to be saving for my future, so maybe not. I don't know. Is it possible that Fred stopped data on excess reserves? I can only find discontinued. Well, there are no excess reserves anymore, right? Since I think 2020, the Federal Reserve has decided to implement monetary policy in what is called an ample reserves environment, so that the reserve requirement is zero. So there is no concept of an excess reserve. I know that sounds odd, but let's see if I can give you sort of a description of what it looks like. And let's say this is reserves in the system, and this is the interest rate over here. And when they say they want to conduct money in monetary policy in an ample reserve regime, it means they want reserves to be high. They want reserves to be high such that any change in reserves isn't going to affect the interest rate, which means you need a demand curve that, if they say, well, here's where we want reserves to be, somewhere in here. That means the demand curve in here needs to be somewhat flat when you get to this level. So you have a demand curve that may look like this, right? And when you get down here and you have a flattening of the demand curve, you have what are called ample reserves. And you have, I believe, if we draw two lines here, this is interest on reserves. This is the overnight reverse repo rate here. And these are the two targets, such that in this, if reserves increase a little or decrease, well, even within this range, if they increase or decrease, notice it's not going to affect where the rate has to be. Where if it was up here, any change, look at how quickly the rate would have to change. You'd have to engage in a whole bunch of open market operations to keep targeting the rate where you wanted it to be if you had this kind of demand curve. Whereas if you have a flat demand curve, you can get this done. So that is basically where they are now. So you have to look at total reserves in the system, as the this is what they can lend money at, right? So if you can lend money at this high rate over here, and the overnight rate is over here, you're going to end up with no reserves in the system. So you need to continue raising it. As you raise the rate, the demand to lend money begins to decrease, and banks start saying, well, at the margin, if we're going to get 5.08% over here, we're good, right? So reserves can be money left with the Fed, or it could be money in a vault, in the bank vault. That's the reserve. As long as you have it sitting somewhere. Well, why leave it in the bank vault when you can put it in here and get 5.08? So this is now competing with everything else, but that is exactly what the Fed wants to do, is to reduce the amount of demand the supply of money going out for loans by having this. Now, when you have monetary policy in an ample reserves regime, you don't need those open market operations. You're basically just targeting these rates such that you are hitting the flat part of this demand curve. I haven't described it as well as somebody else could, so if somebody else has better wording than I've just given you, feel free to jump in. But there are no excess reserves, from my understanding, since early 2020. What is the futures ticker for steel? I don't know. Google CME, steel futures, because I don't know where you are. There's some on ICE, there's some on the CME, and they make a distinction between the exchange you want. You're looking for Globex. Look for the Globex exchange, and you'll find the ticker there. I think it's a two-digit or two-letter ticker. Best way to backtest option strategy, I just do it in a spreadsheet. I download the series, the price series, the closing price series, because that's all I care about is the closing price. And then you could just write call it an algorithm. You could just write an equation that you can then just drag down one column beside the closing price with an if statement, so that the colors turn. Either green or red. Red means you lost on it. Green means it wasn't assigned. And then from the loss positions, you can then create another column which has the amount of shares that you would accumulate. And beside that, you would then list all the calls you sold against it. And then I just use a spreadsheet. So I think there's a software for it. I just don't use any. I agree with your assessment. The neutral rate of interest is likely higher. Two questions. I understand employment is a lagging indicator, but do you continue to see a recession as your base case with employment at record historical lows? It's not. Listen, everything is fine until it's not. Your house is safe until it gets broken into. Your jaw is fine until it gets punched. Everything is okay until it's not, and usually the until it's not happens very quickly. So whenever you look at charts or historical data, you always see these points. Like if you're looking at unemployment over time, you'll see unemployment come down, then it jumps. Then unemployment comes down, then it jumps, and then unemployment comes down. Well, if you look, these were recessions, and then unemployment increases. So here, everything was fine until it wasn't. And here, everything was fine until it wasn't. In fact, you say, look, unemployment's been coming down and down and down and down. Everything is fine until it's not. Everything is fine until it's not. That's if you look at the types of recessions we've had, they were usually precipitated by some event, whether it be endogenous like 2008, the credit crisis, or whether it be exogenous like the pandemic, small mini recession we had, or the early 1990s, which was the culmination of some property crashes, some banking crisis, and Kuwait all at the same time in a short period of time. Everything is okay until it's not. It's just like your health. You're fine until you get sick. That was it. I just forgot the point I was going to make. Anyways, yeah. So the unemployment rate's extremely low. We get that. There is no slack in the job market, which means that any kind of resurgence of economic activity is going to cause wage inflation, because you're going to have to fight for employees again, and you're going to have to steal them away from other people. That's inflationary. And we are in a low growth environment, 1.1% growth in Q1 annualized. We already saw that. That when you have a weak growth economy and something happens, it usually is what sends it into recession. So, all of these things of, look, this is great, this is great, this is great. Yeah, it's all great. Everything is great until it's not. What you have to look at is, yes, but listen, we are in an environment of elevated interest rates. And we're going to be in an environment of elevated interest rates for longer. We're in an environment of tightening credit standards. We're in an environment where a lot of banks have a lot of real estate loans on their books, and $2 trillion of that is coming due in the next 2 years. This is not an environment to be pointing out things and saying everything is okay. Those things are okay until they're not. Don't even look at them. Don't look at unemployment. Don't look at consumer spending. A consumer will always spend. Look at all the other things, because if something is going to happen, it's going to come from those sectors. Unemployment doesn't just start increasing. It increases in response to something breaking. So I don't know that looking at 3.4% unemployment is bullish, is to say, I'm bullish on equities at this point. I see the Federal Reserve is unlikely to cut rates if employment figures continue to hold at historically low levels. I agree, especially if we see inflation gradually come down to acceptable levels. Yep. Do you see the Fed cutting rates to spur additional growth? Nope. No, and it does not matter what I believe. It does not matter what anybody believes. It matters what they say, and they all are saying there are no cuts this year. It would be a massive hit to their credibility if they cut rates. They can't cut rates. Unless something really breaks, take rate cuts off the table. Not gonna happen. Not gonna happen. Hindenburg Research. Yes, I have. Picked another victim. Yes, I know. Icon. It's sort of similar to recent situation in ABR, but not scam and professional house. That not illegal. Well, it's not. I mean, short selling is not illegal. Lying about it, making stuff up, yeah, that can be seen as illegal. But if you have a good case, if you say, look, here's the evidence. And this is why we're short. You can't outright make statements of fact by saying this is a fraud, this is a fraudulent person. You must always start with, in our opinion, this is a fraud. In our opinion, you have to put it all in opinions. You can have opinions. But once you start saying things as statements of fact, and you're wrong, that can be illegal. But if you have a good case for having that opinion, no, that's not illegal. I don't understand your strategy of selling puts between 41.50, 41.70 if you believe the market. Well, I'm doing that for June, for the June underlying expiration, which is 36 days away. If you believe the market is overvalued, we're back to the mean of 16.6. And again, I believe that it is. But it doesn't matter what I believe. It matters what everyone else believes. And right now, from what I'm seeing in the market, there's not a willingness, it seems, to go there. Not until something significant happens. There's just not a willingness to reprice lower. So because there's not a willingness to reprice lower, like the old adage on Wall Street says, don't trade the market you want, trade the market you got. And the market we got right now is absolutely willing to ignore almost everything negative. Absolutely willing to ignore it. Looking past this, we're looking past that, we're looking past everything. Well, you got to protect yourself because you need them to push the market lower. And if them are not willing to push the market lower, you need protection from them. So yeah, I'm willing to sell some puts which have some premium in there. If the market falls, I still make money. I just don't get all the downside. I'm willing to do that and trade off some of the upside I would get from that just to avoid a lot of the downside on the other side. When you're short, you have to be tactical. You don't get to just sit on your hands and say, I'm waiting. You have to be tactical when you're short. There we go. Why not sell calls? Because that would just be adding to my negative position. That would be adding to it. In other words, increasing my risk in the face of a market that does not want to do what I want it to do, not decreasing my risk. U.S. debt ceiling issue. What will be the implication if ceiling is not increased? Don't know because it's never really happened. Everyone thinks that, well, it's just such a bad outcome that the clowns can't be that crazy. They can't be that crazy, we think. That it's such a crazy thing to do that, yeah, they're all just bluffing right now and playing a big game of chicken. And that it will be resolved. Both sides know it's going to be resolved, but it's a game of chicken. Who's going to blink first, right? But it's such a bad outcome that the market is downplaying it a lot, I think, because they think, who would ever allow it to happen? Even crazy people wouldn't allow it to happen, but I don't know if the level of crazy has ever been amped up as high as it is now. Where do I sign up? Level 3 live seminar. It's on the site. We've already had, I forget how many sign up, but we had to take out all the duplicates that signed up for all three time sessions just to make sure that they get into one of them. If you sign up, we'll do what we can here. You don't have to sign up for multiple sessions. Any thoughts on Shopify jump of $15? I didn't see it jump $15. Thought on Shopify jump of 15. I know it's had quite an impressive performance just in the last year. I don't know that it jumped $15. I don't know. I don't really follow it. I think the last news feed I saw, which I only saw because it had something to do with AI, is they removed, was it tens of thousands of songs that were generated by AI, which I thought was pretty wild. That, it never occurred to me that AI could start producing music and just dump it on all these streaming platforms and start actually making money from it. That if you could use AI to create music And who knows, it might create some hit songs, right? I mean, who knows? Wasn't it a collaboration between Drake and Weeknd or something like that? That AI used their voices and actually created a song? Or something, I don't know. Was it a good song? I don't know if it was any good or not. But that's the only thing I saw in AI was they removed a whole bunch of AI generated songs, which I thought was pretty freaking wild. This TD does offer competitive deposit rates. Yeah, I didn't look into that. Yeah, okay. That takes us through everything this week.